All right, now let's take a look at the balance sheet in more detail. So when we're looking at the balance sheet, again, this might be referred to as a statement of net worth or statement of financial position. It goes by all three names. But this is what we call a point in time statement, right? We're going to be looking at the value of assets and also the current value of outstanding debts. And we're going to be using our asset values and our debt values to calculate a client's net worth at a given point in time. And what that suggests is that any other given point in time is that the asset values might be higher or lower than they are based on the current point in time, and debt values might be higher or lower than what they are based on the current point in time that we're observing. Okay, so this is very much a point in time as of a specific date type of statement. So when we're looking at the balance sheet, I think the first thing that we want to recognize is just the accounting equation, right? And the accounting equation says that assets equal liabilities plus net worth, right? And so when we look at the balance sheet in this side-by-side format, also referred to as equation form, we see that the accounting equation shows up in this format, right? Assets on the left side equal liabilities plus net worth on the right side. Okay, so the left side of the equation always has to equal the right side of the equation. And if that's true, then the statement is in balance. Now, this should always be true for us when working with personal financial statements because we're going to calculate net worth as a plug figure. Okay, when I say plug figure, all we're going to do to figure out net worth for our personal financial statements is we're going to say assets minus liabilities equals net worth, right? Assets minus liabilities equals net worth. Okay, so what are assets and what are liabilities? So we're going to use very basic definitions for assets and liabilities, right? Assets can simply be defined as what a client owns, right? What a client owns. And liabilities can take on a very similar simple definition of what a client owes, right? What are a client's debts? Okay, so some examples of assets might be the client's checking account, their investment accounts, any interest that they hold in businesses, personal residence, rental property, personal use assets like their primary residence or their cars. All of these things represent things that a client owns, right? Liabilities or debts represent what the client owes. Okay, so we might have things like a mortgage or business loans or a car loan or student loans or credit card balances, right? All of these things represent debts. So if we set the accounting equation a little bit different, what we could say is what we own minus what we owe equals our equity position in our assets, right? What we own minus what we owe equals our equity position in our assets. And so to give you an example of this, let's just think about a client that owns an automobile, right? Let's say that they own a 2024 Cadillac Escalade, okay? And so their Cadillac Escalade, let's say, has a value of $100,000, and they have a loan on that Escalade for $50,000, okay? So we would say what we own, the Cadillac, minus what we owe, the loan on the Cadillac, equals our equity position in the Cadillac. So $100,000 value minus a $50,000 debt equals equity of $50,000. So it's a very simple definition of what's going on in the balance sheet. The only real difference is on the balance sheet, we're looking at a, a much broader variety of assets and a much broader variety of liabilities. So the totality of what a client owns minus the totality of what they owe equals their net worth, or again, their equity position in their assets. When we say equity position, basically what we mean, if we want to boil that down to a simple definition, is if I took everything that a client owns and I sold it for its fair market value, and I used to pay off all of their debts, what would be left over, right? How much money could the client put into their pocket after that transaction? Now, what we're probably going to be looking at a whole lot more than the equation form of the balance sheet is what we call a list form. Okay. And so instead of having a side-by-side balance sheet, we'll have our balance sheet listed out in a more linear fashion. Okay. Now, some things that we need to be aware of when we're looking at the balance sheet is that assets are always recorded at their fair market value. Okay. Now, some of you guys may have some accounting background again. And one of the things that you learn in your formal accounting classes is that assets are always recorded at historical cost, right? That's a generally accepted accounting principle, a GAAP principle for corporate financial statements. Well, we aren't building corporate financial statements. We're building personal financial statements. And we're not building financial statements so that other people external to the entity can evaluate those financials for decision-making purposes. We're building financial statements for internal decision-making purposes, right? We're building our financial statements so that we, the planner, can perform an accurate analysis and advise our clients well, right? We're building these statements for individual household level decision making. Okay, so all of those GAAP rules that you might have learned about don't really apply to personal financial statements. Now, if you're thinking, what the heck is GAAP? Don't worry about it, because this is going to be the last time that I mention it. We're doing more managerial accounting, right? We're doing accounting for decision making inside the client planner relationship. So, long story short, assets always recorded at their fair market value. Liabilities are always recorded at their current outstanding balance. Okay, their current outstanding balance. Now, when we think about a balance on a liability, let's go back to that Cadillac example that I gave just a second ago, right? I said that the debt on the Cadillac was $50,000. Well, if the owner of that Cadillac is going to pay that $50,000 debt over a 5-year period, they're going to pay more than 50,000 bucks, right? They're going to also pay interest on that debt. When we're recording the liability, we do not, I repeat, we do not worry about that future interest. All we care about when we're recording the liability is the current amount owed on the debt. Okay. Future interest doesn't matter. What is the balance on the debt today is what goes on the balance sheet. Okay. And again, when we're looking at net worth, we're just simply taking assets minus liabilities to calculate that figure. Now, let's talk a little bit more about assets. When we're looking at assets, we oftentimes see the assets broken out into different categories. Okay, and here's some pretty common examples of categories that we might use to classify our assets. Okay, so we have cash and cash equivalents, investment assets, and personal use assets. But remember, I just said that we're using these financial statements for individual level decision-making purposes. If it makes sense when working with a client, you may use different categories than the ones I have listed here. Or you may use additional categories above and beyond what we have listed here. You'll use the asset classifications that make the most sense for adequate evaluation to make informed decisions. Okay, but again, these are really, really common examples when looking at asset categorization. All right, so the first one is cash and cash equivalents. Something you need to know right off the bat about cash and cash equivalents is that they may also be referred to as liquid assets or monetary assets. Okay, so cash and cash equivalents, also called liquid and or monetary assets. Now, the book definition of cash and cash equivalent is any asset that's expected to convert to cash within 12 months. Okay. And this would be things like cash, checking, savings, money market accounts, CDs with a 12-month or less maturity, right? All of these things are things that we expect to be readily available as usable cash within the next year. Okay, so that's a good definition for cash and cash equivalents. I think another way to think about cash and cash equivalents is what is the purpose for holding this asset, right? And so when I look at cash and cash equivalents, in some cases, I'll say that cash and cash equivalents should be the assets that a client is holding with the intention of meeting day-to-day living needs. Okay, the assets that a client is holding with the intention of using those assets to meet day-to-day living needs. Okay, so I don't think anybody would argue that a client holds cash to fund day-to-day living needs. Whatever money is available in their checking account, they're probably planning on spending to fund their lifestyle and so on and so forth. But what about when we start thinking about like emergency funds? Okay, emergency funds might be held in traditional savings accounts. They might be held in some type of money market account or a certificate of deposit, which is what's called a time-based account. So what if they're holding it there? Well, they're not necessarily planning on using that money to meet day-to-day living needs, or are they, right? So let's take an emergency fund as an example, right? We would say, no way. A client is not holding an emergency fund to meet day-to-day living needs. Well, then the question arises, well, what if the client loses their income, right? What if they lose their job, right? Where are they going to go to fund their day-to-day living needs? That's the whole purpose of the emergency fund, right? The whole purpose of the emergency fund is so that if an unexpected event occurs, we can fund that event without disturbing the plan at large. Okay, so I would say that emergency fund holdings are held for the purpose of meeting day-to-day living needs. It just might not be in the current period, or it might be contingent on some event taking place, like the loss of a job, a major medical event, or something like that. Okay, so that's just another lens that we can view cash and cash equivalents through as we think about how should I classify certain assets that a client is bringing to the table. The next category that we look at is investment assets. So when we're thinking about investment assets, these are the assets that the client is holding with the purpose of using them to achieve their goals. Okay, so we might be looking at brokerage accounts that include stocks, bonds, mutual funds. We might be looking at retirement accounts, whether it be 401ks, IRAs, or other types of retirement accounts, or business interest, rental real estate. There's all kinds of things that we might be holding to grow our wealth to fund goals. Okay. So that gets us back to intention. What is the purpose of holding a certain asset? Well, we would say that if the purpose of holding an asset is to grow wealth to fund goals, then you're dealing with an investment asset. So the example that I oftentimes like to use is a personal residence, right? And so the argument that you hear a lot of times from an asset classification standpoint is that a personal residence is something that increases in value over time and likely leads to a long-term increase in net worth. I would agree with that completely. And so you hear the term or the saying that, buying a home is a good investment, right? Well, what's the purpose of owning a home? Maybe for some people, it is to achieve financial goals, right? Maybe they plan on flipping that home. Maybe they think they can profit. Maybe they want to use it for income and retirement through the use of a reverse mortgage, right? There's potential investment-like intentions for holding a personal residence, but the vast majority of people hold a personal residence for personal use. Even though it increases in value, the intent of use is not to fund long-term goals. It's to live in on a day-to-day basis, right? And so intention, I think, is really important because we're going to look at these different asset sections and say, what's available to fund the goal? And if we have assets in sections that don't meet the intended use of those assets, then I think that we start to maybe look at the plan in a little bit of a skewed way. And so I think intention of use is very, very important when evaluating asset classification. Okay. So last but not least, we have personal use assets. Again, I think that a personal residence meets this definition. Personal residences are pretty bad at producing income. We really like our assets, or I'm sorry, our investment assets to not only increase in value, but also produce income. Personal residence, really good at producing expenses, not so good at producing income, unless we're talking again about a reverse mortgage or something like that. But cars, collectibles, things of that nature are all going to fall into this personal use category. So other categories that you might see retirement assets, business assets, real estate assets would be an extension of the three foundational categories that we discussed on the previous slide. Okay, so let's just look at this really quickly as an example of what I'm calling accrual basis accounting, right? So it's October 1st, and a client decides to update their balance sheet. They have a $10,000 check that's been deposited in their checking account. They have $4,000 in miscellaneous bills on their desk, bills that have not been paid, and a $1,500 mortgage that needs to be paid as well, right? What should they do on the balance sheet? Okay, so the check has been deposited, right? That is something that has gone into their checking account. And so the cash and cash equivalent should increase, right? The checking account has increased, total cash and cash equivalents also increased. Because we don't care about expenses until the cash flow takes place, then the 4,000 and the 1,500 don't matter yet. Okay? So if we were to say, oh man, there's $4,000 in bills that need to be paid, right? Sitting on the client's desk. Well, one way you could do that is you could say, hey, listen, I'm going to use accrual basis accounting and I'm going to record a $4,000 liability, a debt, right? I owe $4,000 to upcoming bills. Same thing for the mortgage, right? We have a $1,500 mortgage that's due. So I have a liability, upcoming mortgage payment. That's accrual basis accounting, right? That is saying, hey, listen, the expense needs to be recorded when it is due, not when it is paid. Okay? We're going to make it simpler than that. All right? We'll only record the 10,000. So the answer is number one, right? We'll only record the $10,000 increase in assets on the balance sheet. The 4,000 and 1,500 will not be on the balance sheet. Okay? They will, however, be expenses on the income and expense statement when that cash outflow actually takes place, right? There'll be expenses on the income and expense statement when that cash outflow actually takes place. In addition to being expenses when the cash outflow takes place at some point in time in the near future, our cash balance will also go down, right? Our cash balance is going to go down by the $5,500 that the client pays out to satisfy their bills. Okay, so we'll talk about this more as we continue our conversations on this topic. I just wanted to illustrate the difference through an example of cash basis accounting versus accrual basis accounting. Okay, so let's look at another example of a transaction and its impact on the balance sheet. Susan purchased a truck for $30,000. It's currently valued at $15,000. What do you enter as an asset on the current statement of net worth? Okay, so remember, we don't care about the historical cost, right? $30,000 doesn't matter. When we record assets, we always record assets at their fair market value. And so its current value, its current fair market value is $15,000. And so we will record an asset on the current statement of net worth of $15,000. Okay, so answer number 2 is correct. So when we're looking at liabilities, we also classify them into 2 different categories. We have current and short-term liabilities, mean the exact same thing, right? And then we also have another category, which is long-term liabilities. Okay, so when we're looking at our current or short-term liabilities, these are obligations that are due in full within the next 12 months. Okay, so when I say obligations due in full within the next 12 months, what I mean is debts that are going to be paid off entirely within the next 12 months. And like I said earlier, we're not going to worry about any future interest that's owed on those debts. We're only going to record the debt at their current balance. Okay? Now, other things that we need to know about current liabilities is that credit cards, regardless of their balance, are always considered current liabilities, right? Credit cards, regardless of their balance, are always considered current liabilities. Okay, and I just gave you an example. Unpaid bills. This is actually a typo on this slide. Unpaid bills will not be considered current liabilities because we are using cash basis accounting. Okay, so you can disregard this as an example. Now, one of the questions I oftentimes get for people that have some experience with accounting is, should the short-term portion of long-term debts be recorded as current liabilities? And the answer is, you have the freedom to do whatever you want. Okay. And so let me give you an example, right? Let's go back to that Escalade example again that I gave earlier. We have a debt on the Escalade of $50,000, right? And I said in the example earlier that we were going to pay that debt, or the client was, over the next 5 years. And so because it's going to take 5 years for that debt to be paid in full, then that debt should be classified as a long-term liability, right? Not going to be paid in full within the next 12 months, needs to be classified as a long-term liability. Well, for simple math's sake, let's say that over the next 5 years, we're going to pay $10,000 of that debt per year. So after 5 years, at $10,000 per year, the full $50,000 balance will be paid off. Okay, so the question again that I get all the time is, should the portion of this long-term debt that we just recognized that's going to be paid in the next 12 months be recognized as a current liability? In other words, should $10,000 of the Escalade loan be a current liability and the remaining $40,000 be a long-term liability? And I just said you can do whatever you want. What you do need to know is that if you choose to take the current portion of the long-term liability and classify it as a short-term liability, that is accrual basis accounting. And because we use cash basis accounting, it is not required that you do that. Now, it might be helpful to know, and so that's why I give you the freedom to say, if it helps make better decisions, then take the extra step to split the debt up. But in pure cash basis accounting, we would not do that, right? We would just leave the full $50,000 as a long-term liability and record no part of that in the short-term section. So again, it's up to you. I see it both ways, and I'm perfectly fine with either way. If it's helpful, split it up. If it's not, take the more basic approach. Okay. I'm going to skip that slide. So here's a question. How is credit card debt categorized? Again, regardless of the balance, it's always always classified as a short-term debt. So again, here is an example of a linear financial statement using the categories that we talked about throughout this presentation, right? In the assets section, we see cash and cash equivalents, investment assets, and personal use assets. And in the liability section, we see current liabilities and long-term liabilities. All right, so let's look at an example and talk about what happens to net worth based on the transaction that we're observing. So it says a client purchases a new piece of art to hang in the living room for $40,000 with a down payment of $5,000 in cash and a $35,000 loan. What's the effect on the client's balance sheet of this transaction? All right, so let's just look at this and classify these things really quickly, and then we'll talk about the effect of the transaction. So the piece of art that's going to be hung in the living room has a fair market value of $40,000. And so art is a personal use asset, and $40,000 is its fair market value. And so we would add an asset under personal use assets of $40,000 to the balance sheet. Okay, and it says that they use $5,000 in cash and a $35,000 loan to purchase this piece of art. Okay, so $5,000 in cash, because that is an outflow, then cash on the balance sheet is going to go down by $5,000. And then we also borrow $35,000 to fund the remainder of the transaction. And so we'll have a new loan on the balance sheet of $35,000. Okay, so the impact on net worth is zero. Okay, so let's break that down just a little bit. We have a decrease in cash of 5,000, but an increase in personal use assets of $40,000. Now, notice that this says potentially investment assets. If the art was purchased because the client believes that it's going to appreciate in value and they just want to hold it until it appreciates to a certain level and then they plan to sell it for a profit, sure, we would call that a personal use asset. If they bought it for the living room as something that they just want to enjoy as art and part of their decorations, then that's a personal use asset. So again, intention matters with regards to how we classify. Okay, so we have a $5,000 decrease and a $40,000 increase. So the net effect on assets is a $35,000 increase, right? 40 minus 5, $35,000 increase in assets. Liabilities also increased by $35,000 when the client brought on the new loan. So $35,000 increase in assets, $35,000 increase in liabilities. So assets minus liabilities equals net worth. So if we say 35 minus 35 equals 0, right? No impact on net worth in the immediate term for this transaction. Okay. Now, if the asset goes up in value, then we have a positive impact on net worth. If the piece of art goes down in value, then we have a negative impact on net worth. But that's not going to happen today, right? That's going to be something that takes place over some future time period. Same thing for the liability. As the liability decreases when the client makes the payments on their loan, then the total debts go down, which means that net worth will generally go up. So again, something that happens in the future, not today. The immediate impact is 0. Now, a balance sheet does also have some limitations, right? The balance sheet shows assets at their fair market value and debts at their current balance, but it doesn't show what causes an asset to increase or decrease. Okay, and it also doesn't inform us about anything that maybe a client could do to experience positive outcomes with regards to their assets. It just shows what their value is. We have to use that information and go above and beyond just what's shown in the statement to perform a more sophisticated analysis to anticipate how asset changes might impact net worth over time. Okay, it also doesn't tell us anything about motivation, right? Why did the client purchase the asset? Why did the client assume the liability? Okay, and we just don't know what those motivations were and where those things came from unless they were part of the advice that we gave as part of the plan. But anything that happened prior to the advice is just an observation. And unless we ask questions to the client, the statement is not going to communicate that to us on its own. Okay, and then we also can't really see exactly what's causing net worth to change. Now we can go in and look at assets and liabilities, and we can do year-to-year comparisons and values and say, okay, how are asset values changing? How are liability values changing? And we can perform a horizontal analysis, which we'll talk about a little bit later, to observe changes over time. Okay, but it doesn't say on the face value of the statement, like, oh, I see exactly what happened to create the outcome that we observe in terms of net worth. Okay, so it's just a point in time statement. What is the value of the client's assets and liabilities today? And what does that tell us about a client's current net worth? For all that other information, we have to take a deeper dive through some analysis. But the balance sheet will be extremely helpful in that analysis. And this is a statement that we're going to see commonly used in financial planning and that we're going to use throughout the remainder of the semester.